3 ways wealthy people avoid taxes. One of the things that the wealthy people all know is that it is important to plan ahead to save on taxes. They are not waiting until April to find out how much taxes they owe for last year's income. Most high income and wealthy people have an open line of communication with their tax advisor, so they know ahead of time how to earn that income, what entities to earn it in, and what they can write off. This is a very key part if you truly want to save on taxes. Like with anything, if you don't know where you're going, it's going to be very difficult for you to get there. So if our goal is to save on taxes, then we need to have a plan on how to do that. One of the first ways that the wealthy are able to reduce their taxes is by maximizing their tax deductions. You probably know this already, but a lot of wealthy people typically invest in businesses and real estate. The reason for that is those asset classes not only help you to build wealth, but they also come with a slew of tax benefits. One of the biggest ones is the ability to take tax deductions. When you invest in a business or when you invest in real estate, you are now a business owner in the eyes of the IRS. And what that means is that you are allowed to take tax deductions against the income that you generate from your real estate or from your business. This is very important because the more income you make, the higher tax rate you're in. So if you're someone who's making $300,000, $400,000, $500,000 and your tax rate is over 35%, $100 in tax deductions can save you $35 in actual taxes. So very important lesson that a lot of wealthy people know. And like I said, you don't have to be the wealthy to save on taxes like they do. If you have rental income from your properties, making sure that you capture and maximize your tax deductions really goes a long way in terms of reducing your overall taxable income. Because let's face it, if you can make $5,000 more from your rental properties this year and pay 0 tax on it through write-offs, then isn't that a win? Investors are often confused about exactly what could be deducted. We're all really good about making sure we write off our mortgage interest and property taxes or even property management fees. But what a lot of people miss out on are the overhead expenses that we are using for our personal as well as our business. Common ones like home office, car expenses, maybe business trips that have some kind of personal benefit or personal enjoyment as well. Make sure you try those expenses because they do go a long way in terms of helping you to save on taxes. And like I said, you don't have to be a millionaire to take business deductions. In fact, you don't even need to have a legal entity to take tax deductions. For example, if you just started a side business or you just started investing in your first rental property and you don't have them in LLCs, you can still take a tax deduction for those. Wealthy people know the game of getting tax-free money. New York Times came out with an article a couple years ago about how some of the super wealthy individuals in the United States paid very little to no taxes. One of the strategies that they talked about was the ability to access their assets tax-free. In that article, they talked about how people like Warren Buffett were able to tap into equity built up in their business and not pay any taxes on all that money through loans. And if you think about it, it's actually something that we can all do as real estate investors. So for example, you bought a property on Main Street, that's a rental. Over the years, let's say the property has appreciated in value. If you sold the property, then you may have to pay taxes on it, unless you do a 1031 exchange. But what if I wanted to continue holding onto the property, but I also wanted to tap into the equity of my property? What you can do is a cash out refi. When you do a cash out refi, the loan proceeds are not taxable to you right now. And so it's a really great way for you to get access to some of that built up appreciation in the form of cash and not having to pay any taxes today on that money. A lot of times the media makes it seem like these strategies and the tax law is very skewed towards favoring high net worth and wealthy individuals, when the reality of it is we all play by the same rules. Whether it's a primary home that's appreciated, you can tap into the equity via a loan without paying taxes today. If it's a rental property, you can also borrow against that equity without paying any taxes. Let's say you have a big stock portfolio. If you sold your stock, you likely have to pay capital gains taxes on it. And currently capital gains tax is as high as 20%. If you instead borrowed against your stock portfolio, guess what? Now you've been able to access that money without paying any current taxes. If you know the rules and you learn them, you can use it to your advantage as well. Another way that the wealthy love to use to save on taxes is through a concept of tax deferral. Tax deferral simply means I want to find ways that I can pay taxes later rather than paying them today. Sounds like it's very complicated, but these are things that we as real estate investors use all the time. Take the concept of depreciation. Depreciation or accelerated depreciation basically allows me to take a higher deduction up front so that I can offset more of my taxable income today. In exchange, maybe I will pay taxes on that income later on and kicking the can down the road. For real estate investors, one of our favorite tax benefits is 1031 exchange. That is our ability to sell a property that's gone up in value and defer the capital gains taxes on it as long as we follow the rules and buy replacement properties in a valid 1031. What I also love about the 1031 exchange is not only does it allow us to defer taxes into the future, if you do it correctly, you could potentially avoid taxes forever. And this is another secret that the wealthy love to use. So for example, let's say mom and dad bought a rental property for $100,000 years and years ago. Over their lifetime, they can keep selling and trading up in a valid 1031 exchange to defer the capital gain taxes. If you do it correctly and the assets pass away in the parent's name, the kids and the beneficiaries actually get what's called a step-up basis in the property. So if I bought a rental property for $100,000, I keep exchanging, and by the time I pass away, my rentals are worth $2 million. Well, guess what? Nobody ever pays the taxes on the $1.9 million of appreciation through the entire lifetime. And this is one of those great strategies that the wealthy often use, and we can use the same too. And believe it or not, the step-up basis strategy is not just limited to real estate. It works exactly the same way with companies as well as stocks. So what we tend to see is a lot of wealthy people who will hold stock portfolios or who will have businesses set up so that when they pass away, it gets to the kids and grandkids and nobody pays any taxes on all of that appreciation and gain that's occurred throughout their lifetime. So there you have it, a couple major ways that the wealthy use the tax law to their advantage to pay very little or no taxes. And you can see how some of these are actually really simple things that we as everyday investors can do as well. All it takes is knowing the rules so that you can play to win. If you like this video, please be sure to hit the like button and subscribe for more tax strategies.